Hello. So recently I've been looking at the prospect of buying a home. I've been waiting a few years to buy one, but until recently I've been pretty much completely priced out of the market. The common narrative, at least among retail investors, is that housing prices are very overpriced and due for a crash, similar to something that we saw in 2008. And that makes sense, I think, because the majority of so-called middle-class workers have been completely priced out of the market since 2021. There are a lot of opinions, some good and some bad, about which approach is best for buying a house. For most families that are trying to get started, there are two options. One, buying a small to medium-sized home, or renting one. Sure, you can rent a cheaper apartment or come up with a creative living arrangement that cuts costs, but right now I just want to look at the stereotypical American dream case where a young family moves out to the suburbs to have children or just to have a little space between them and their neighbors. What I want to do here is take a fresh look at the housing market and the data that makes the most sense to me. Maybe we'll gain some helpful insights along the way. Okay, so I want to go over a few disclaimers for this presentation. The main thing is that the data I took, I didn't verify sources. I basically looked and saw, does it look right? Does it look close to data I've seen elsewhere? If two data sources look similar, they're probably correct. That was sort of the working assumption I looked at. I'm not really using any obscure data sources, but it is hard to find data that goes so far back. A lot of the data has been interpolated, a lot of the data has been patched together by various sources. And so the takeaway here is you probably should look at this as just an approximation. They're not exact numbers that come out of this. We're looking for general trends, not specific calculations that are trying to find any sort of edge in the market. The other main thing is individual markets, individual circumstances vary widely. This is kind of taking the one-size-fits-all approach, which isn't suitable for individuals. Individuals, I think, should take this data, learn from it, and apply it to a more specific study on whatever market you're looking at. The US is a big place, and so there's a lot. Aggregating all the data into one sort of median average is not very effective for looking at specific investment decisions or purchasing decisions. It is, I think, good for looking at the overall big 1,000-foot picture. To start off, I want to look at a few different data series. The M2 money supply in red, the Case-Shiller index in green, and the CPI in blue. Now, this is a data set spanning over 100 years since 1900 all the way to present. And on the y-axis is the log plot of these data sets. A logarithmic chart is very helpful for plotting exponentially increasing data series. So it shows the rate of growth year over year, essentially, rather than just the absolute value year over year, which is an exponential data series they're much easier to interpret and see what's going on when you look at a logarithmic chart as to opposed to a normal linear chart. It's basically a one-to-one mapping rather than, mapping something that doesn't fit well on a linear chart onto a linear chart. So that's why anything related to stocks, market prices, anything that exponentially grows over time is good to look at on a logarithmic chart. So what is the M2 money supply? To quote Investopedia, it's the Federal Reserve's estimate of the total money supply, including all the cash people have on hand, plus all the money deposited in checking accounts, saving accounts, and other short-term savings vehicles such as CDs. And it excludes retirement accounts and time deposits that are above $100,000 in value. So in other words, the M2 money supply is a measure of all of the cash and cash equivalents that the US consumer has readily available, or just that they possess in the banking system. And you can see this has grown at the fastest rate over time, significantly faster than CPI or the Case-Shiller index. The slope of these trend lines is kind of what's important here more than anything else, because these are normalized charts, normalized to something kind of arbitrary. So really all you care about here is the slope, the fact that they are in a consistent uptrend. The M2 money supply is consistently expanding over time at a rate that's faster than the CPI or Case-Shiller index. So what's the CPI? The CPI is the Consumer Price Index. It's the way the Federal Reserve, well, actually, I'm not sure if that's the Federal Reserve. I think it's the Bureau of Economics, measures the rate of growth of consumer prices and the cost of living. So in theory, this should track the cost of living fairly well over time. And you can see from 1900 to 1940, it was actually in a really shallow uptrend. And right about 1940, that uptrend increased significantly, even though the M2 money supply rate of change did not increase that significantly. So that's interesting. I'm actually not sure what caused that. Maybe it was an increase in lending. Yeah, I really am not sure what caused that. But you can see that happened with the Case-Shiller index as well. Now, the Case-Shiller index is an index that is supposed to track home prices in the US. So the National Case-Shiller Index would track home prices. And you can see that the rate of change of home prices had increased, home prices have increased faster than the Consumer Price Index. So this Consumer Price Index, I guess, is probably taking into account deflation in technology and other things that are fundamentally deflationary forces that don't affect hard assets like houses. There's other reasons house prices have changed over time. And you can see within shorter time frames, if you zoom in, like there's pretty big deviations from the main trend line in both the CPI and the Case-Shiller index. You can see with the housing bubble in 2006, this deviated pretty significantly from the trend line, and then it undershot the trend line very significantly. The next thing I wanted to look at is the Case-Shiller trend since basically 1940. Now this is the same plot as what was on the previous chart, but this time I just put basically standard deviation bands around the trend, or around the actual data, so that you can see a little bit better what it's bounded by. So you really have boom and bust cycles. How many years? 1950 was kind of a peak. It troughed around 1970, so that's a 20-year cycle. And then 20 years later, it peaks again. This time it only takes about 10 years to trough, and the trough is not as shallow or as deep. And then the next peak overshoots this trend line by a good bit. That's the 2008 crisis. And then it moves all the way back down to the bottom. And you can see where we are now is kind of a little bit above the mid-range. So in terms of absolute prices, it's not like we're outside the trend line. That's a very narrow range uptrend. And then it accelerated significantly going into 2022. And since then, it's been kind of creeping up a lot slower. Yeah, looking at this same data in a different way, this time all I did was I took that trend line that governed the long-term trend, and I divided the data by that trend line. So now you can see, I guess, a different view of when our house price is relatively cheap and when they're relatively expensive. Now I'm ignoring whatever happened before 1940. Looking just at this data, again, we had sort of these are sort of your peaks and troughs of the housing market. And right now, according to, just looking at price alone, we're kind of in the mid-range. So what I think hurts the consumer is just the rate of increase in those housing prices. And it's kind of interesting because that tends to be nothing new. The periods of stagnation are relatively rare. Like, they last a long time, but there's not that many of them. Most of the time, the prices are either crashing or skyrocketing with respect to the long-term trend, at least. Okay, so this chart looks at the CPI versus the Case-Shiller index. These are normalized, so really all I was trying to do, these are, again, both on a logarithmic scale, normalized and all I was trying to do here is look at, is there a divergence between the CPI and the Case-Shiller index? And surprisingly, like from 1900 to about maybe 1970, 1980, somewhere in there, these two track each other extremely well. But after 1980, they diverged significantly. So the CPI stopped tracking housing prices about at 1980. Now, that's an important number, 1980, 1981. That's important, and we'll come back to it in a bit. Or that's an important date, I guess I should say. And we'll come back to it later to see why it's so significant.
The next chart is a chart of the U.S. 10-year Treasury note going back to the 1800s. U.S. Treasuries are important because they have huge impact on everything from corporate bonds to stock valuations to mortgage rates. In specific, there tends to be a 0.5% to 2% spread between the 10-year Treasury and mortgage rates. Mortgages have a higher interest rate than Treasuries for a few reasons, but the main ones are that they are higher risk and less liquid. People can default on mortgages. The U.S. government is not expected to default on its obligations anytime soon.
So you can see back in 1920, it was about 5%. You have a huge spike in the 80s. This is like an unprecedented spike where Treasury notes spiked all the way to 15.8%. And since then, the rates have been going down steadily. Rates bottomed in 2021 or 2020, and they have rocketed up at the highest rate in recorded history, at least from the zero bound. You can see how low these rates got down to, all the way down to 0.5%. People who were lending right here were not making money lending to the government, but they bought those bonds anyways because they needed to, it was a flight to safety. And I think mortgages bottomed around 1.5% to 2%. What does this mean for housing prices, and what does this mean for the amount you pay for for housing? The higher the mortgage rate, the more you're going to be paying for to service your mortgage. If you get a 30-year mortgage and you get a 10% loan on that mortgage, you're going to be paying way more per month than if you had gotten, say, a 2% loan on that mortgage. What that means is that it drives prices higher when rates go down, because temporarily people can afford to buy a bigger house or buy more house, but the market corrects for that by driving prices up. So since 1980, this has been a huge driver in bringing housing prices up. From 1940 to 1980, the opposite effect occurred. Increasing rates made it harder and harder, or more and more expensive, to purchase the same priced house. The intuitive thing would be, okay, housing prices must have absolutely collapsed from 1940 to 1980, at least in real terms, because they skyrocketed from 1980 to 2020, right? That's what makes sense. So we'll see in a little bit if that's actually what happened. Okay, so this is the median sales price for houses since 1965. You can see during the period of, at least early on, 1965, there was a couple years where prices actually nominally went down a little bit. You can see there's a little bit of a price decrease over that period of time. But then prices go up pretty deeply into 1980, which was during that time of very high mortgage rate increases. There's another period of slight house deflation in 1990, 2008 to about 2006, 2007. The prices peaked. They bottomed in 2009, and then there was another big period of increases in prices. 2017 to 2020, there was a period of stagnation. Prices backed off a little bit, and then they surged up higher again, and they backed off a little bit again. So housing prices have actually started to turn down and come down. How low they'll go remains to be seen. Something I think is more important than that chart, though, is the chart of the 30-year mortgage payment. This shows sort of the effect of the combination of very fast increasing housing prices and very fast increasing mortgage rates. You can see from 1970, you almost didn't even, okay, so you had a very slight decrease in your average or your median mortgage payment from 1970 to, let's call it 1971. Then the prices skyrocketed very fast into 1980, and then they gradually increased on the period of 1980 to about 2020, and then they skyrocketed again. Up to this point, I think this is the most important chart to look at. This is the median household income ratios. So this looks at two things. In the orange, it looks at the home price, median sales price, divided by median household income. In the blue, it's the mortgage price divided by the median household income. So you can see a relative look at how house prices have outpaced the rate of increase in household income. Now, if household income kept up with home prices, then this orange line would be flat, but it's in an uptrend, which means it confirms what everyone sort of already knew, which is that home prices have outpaced income. And recently, in 2022, at the house price peak, homes were more expensive to the consumer than they've ever been. If you look at this from a different perspective, which is the mortgage payment that you're paying on the house, it looks a little bit different. It shows that in 1980, this was the most expensive it's ever been. And okay, these are normalized. So like the 2.81, that means nothing. The numbers themselves mean nothing. The trends are what matter. Like this point relative to this point. The point I'm trying to make here is that in 1980, for the consumer, the home prices were basically the most expensive they've ever been. And since then, we've had a downtrend in home price to income ratio. So the best time ever to buy a house was actually when rates crashed in 2020. And since then, well, now it's a much worse time to buy a house. Now it's a worse time to buy a house than the peak of the 2006 housing bubble. So suddenly things went from really good for the consumer to really bad for the consumer. And it could get a lot worse if rates continue to increase as they have. One thing I think it's important to note here, though, is that this looks a lot like a top in the trend, much like previous tops. And at least in the short term, and then when I say short term, I mean 2 to 3 years, prices could come down, or at least the amount that consumers have to pay. So I think short to medium term, home buyers will have an advantage and things will get much better for them. Looking at this chart, that's what it seems to indicate. And if we are heading into a recession, rates usually drop, which would bring the effective price down. Nominal home prices have already started dropping. There's a lot of regions where they have not started to drop yet. Like in my region, they haven't even started to drop. They're still at all-time highs. So a lot of it is regionally dependent. But I think in general, prices will get better, or at least affordability will get better for the consumer. Prices might get better, but you're putting off potential. I mean, by buying a house now waiting to buy a house, you're not putting equity in the house. All the payments you're making, if you're renting, assuming an equivalent sized house that you're renting versus buying, that's going to a landlord, not going into equity that is stored for the future. So there's like zero investment involved if you continue renting. And so you're not building up any equity, you're not building up any basically value in that house that's on your name. So really the question is, how long is it worth renting versus buying? Isn't it better to just buy when you can afford it, regardless? Or should you wait and try to time the market? And I think there's a few things that I've looked at to try and answer that question. The first thing is comparing median rent payments to median mortgage payments, and then looking at the added expenses on top of the mortgage payments that make up the cost of owning a home. Now, rent payments have been extremely consistent throughout the years. Now, the data set I used for this, I think, for these rent prices was a St. Louis Federal Reserve data set for a rent index. And what I did was I normalized this to basically, I think at 1998, like the late 1990s, so that the price would be the same as a mortgage payment price. And that gets pretty close to actual rent payments, median rent payments in the US. And it doesn't need to be perfect because obviously like you're not looking in the US for renting, you're looking in your local region for renting versus buying. So it doesn't even matter if it's perfect. What matters is that it's close enough to make a comparison. So the first thing you notice, rent prices have never dropped, at least on this rent index. Probably locally they've dropped. This is such smoothed out data that, there's probably little divots in reality that are not shown on this chart. So there's periods of time when mortgage payments, which is the red line, are above rent payments and times where they're below rent payments. And you can see from about 2007 to about 2022, mortgage payments were significantly below rent payments. Now, this doesn't take into account the ownership costs. And the ownership costs, I estimated as a compilation of homeowners association fees, property taxes, maintenance fees, and insurance. So that's what goes into ownership costs. And that adds, quite a significant amount. In 2010, it would have been about $500 added to that cost. And that brings the total cost of owning a home most of the time up above the cost of renting. Like you can see, if you can ever get down to the cost of renting, that's pretty much like the best time ever to buy a house. It doesn't happen very often. I don't expect it to happen again, in the next decade or two. But never say never. And just as in the other charts, the total cost of owning a home is essentially a scaled mortgage payment cost brought up or down a little bit. So on this chart as well, it looks as if it's rounding out a top and will fall to some degree. So now that you've done that and looked at home prices compared to rent prices, the question is, how do you apply that to actually tell whether it's worth it to buy now or buy later? And the answer, I think, obviously comes down to the amount of time that you are planning on owning the house, because you're looking at paying a mortgage payment plus paying all the associated fees with owning a house versus renting. That's short term. And then if you buy a house, you're going to have to pay closing costs and all of the upfront costs associated with getting a mortgage and actually buying a home. So there's a big upfront cost that you're never going to get back. It doesn't go into equity. It's just gone. And so you have to consider, okay, there's going to be a minimum time that you have to own the house to actually break even versus renting. And when I say break even, I mean like total equity that you have in the house. The trade-off is looking at, if you buy a house now, your mortgage rate is going to be fixed, or your mortgage payment is going to be fixed, at least until you refinance. Your equity is basically whatever the current market value is minus the outstanding loan balance. So if house prices drop faster than you're paying off your loan, then you're going to have negative equity on the house. You're going to be underwater on that house, which is not a situation you want to be in. Basically, you're trying to bucket your way out of a sinking ship at that point until at least it bottoms, and it could take years for the housing market to bottom. So that's an important consideration. Another important consideration is you're probably going to be paying more to buy a house each month than to rent. And so you have to take into account the amount of money, like the opportunity cost of where that difference between the cost of owning a house versus the cost of renting goes. So if every month you're paying $2,500 on your mortgage payment, but you would only be paying $20 or $2,000 to rent, then that's $500 that you don't have that would have gone into other investments or savings. So that would also be considered a negative on the house equity. So when you buy a house, this is an example calculation from buying a home using 2020 sort of nominal or average median values. Median home price then was $330,000. Median household income, $68,000. You have a down payment of, I think, 15%, which comes out to $49,000. That doesn't really do anything to your equity because you paid your down payment. That's an upfront expense, but it doesn't really increase your equity because it just goes from your savings account to saying you paid off part of that mortgage. It goes from an asset in your savings account to equity in the home. So that's not like a net positive or negative to you. The principal loan amount, $280,000. Your closing cost is $11,000. So that's a negative. That's something you're going to lose and never get back. Tax benefits. I didn't actually include these in the calculation because there's a lot that goes into it and it varies year by year based on how much you have left on your loan. But given a year, if you would have included this would have been a tax savings of almost $1,200, which is around $100 a month. That's not included at all. Recurring expenses, property tax, I think I said it was about 1%. $3,000 is 1% per year. Owners Association, whatever that is, comes out to $500. Insurance, $1,400. So that's 0.5% almost. Maintenance, about $5,000. I think that's a little excessive. I think I actually downed that to be just 1%, so around $3,000. Interest rate of 3.3% makes your mortgage payment over $1,200. And these are monthly expenses. So you just divide all these values by 12 to get your monthly property tax, homeowners association fees, insurance, maintenance, and tax savings, which again I did not include in these calculations, which gives you a monthly payment of about $2,000. This is a little off, but I think that comes down to the fact that I changed the maintenance fee cost from like 1.5% to 1% per year, and that's a percent of the total home value at that time. And so, interestingly, in 2020, the cost of owning a home was about the same as the cost of renting. So now we can go over to this disgusting looking plot and ask ourselves what's actually happening here. This shows that if you buy a house at the median price on any given year at the market mortgage rate, how underwater or above water are you going to be on a given year? You can see the legend here. Blue is 1 year after you buy the house. You can see going up to about 1973, you're basically break even for buying a house versus renting after 1 year. After 5 years of owning the house, you start to gain some equity. 10 years, more equity. 20 years, more equity. 30 years, the mortgage should be paid off, and that's when you have the most equity. But then there's times when you don't break even. And this is assuming that you never refinance. So this chart assumes that the mortgage rate you have when you buy the house is the mortgage rate you're going to have all the way for that 30-year loan. So if you bought 1982, this is like the worst possible time to buy a house. After 30 years, you're still underwater with that house. Like, it's paid off, so great, but that's a lot of opportunity cost. You could have used that money somewhere, in some investments, and it would have been much better used if you had just rented and used that money to invest. Oh, actually, no, it actually starts to swing back after 30 years. So you're more underwater after 20 years than after 30 years here. So there's different periods of time in history that it's a good time to buy a house and a bad time to buy a house. Now I'm going to bring in this other chart that shows a little bit more clearly. Instead of showing after a certain number of years how much equity you have in the house, it shows how many years to break even on your investment in buying that house versus renting. So if there's no bar shown, that means after 30 years you're still not breaking even. But you can see how amount of time it takes basically skyrocket. It's from 1980 to 1990, comes back down. It's been in a downtrend all the way up to 2020. Obviously, I don't have 30 years of data in front of 2020 or to be able to see the break-even time. So this basically means from the time, say 2018 to 2024, when the data set ends, that's 6 years, you haven't broken even in that time span. That's great, but people are probably going to refinance their houses if rates get better after they buy the house. If you can get a 30-year fixed mortgage and refinance it, you're probably going to do that if you can lower your mortgage payment. And it's usually not very expensive to refinance, so it's almost always a good idea to refinance if the payments go down. So this just shows what happens if you refinance whenever mortgage rates drop at least 1%. It takes into account, I think, 1% of your loan remaining balance as part of the refinancing cost. So a $300,000 house, basically by refinancing, you add $3,000 to the balance on your loan, or you lose $3,000 of equity by refinancing upfront, but you gain a lot long term because your payments go down, which means you can use that money to do other things with, like other investments, the savings from your payment decreasing. So you can see all across the board, if you do this, pretty much by 20 years, you're guaranteed to be above water if you refinance when housing prices or when mortgage rates go down. It wasn't until like 2010 to 2020 that you break even in 10 years or less. And this chart shows the break-even times for this. It's kind of the same as the other chart, but there's, if you kind of bought a really bad time, you're breaking even in less than 30 years by refinancing. But across the board, most of the time, it looks like it's taking at least 10 years for a long period of time, at least 10 years to break even on your house investment. It wasn't until 2010 to 2020 that housing prospects got really good. And then, obviously previously to this huge inflationary surge, actually, I think inflation started in 1965 or so, but it really got going in the 70s to 1980. So before this huge inflationary surge, or the big part of it, it also didn't take very long to break even on your housing purchase. But this is great. This is the past. How does it affect the future? I mean, how do you use this to make a decision based on an uncertain future? I think one thing we can do is at least look at these two charts side by side and see if we can find any correlation that might be used to get some sort of advantage going into the future. Now, I don't have a trend line on this 30-year mortgage payment chart, but you can kind of get an idea of what is going on. So if you buy a house in 1986, when this price drop or bottoms out, you're getting a 13 and a half year break-even time. But the actual probably best time to buy would have been a year earlier. So if you go a year earlier, that was actually during the downturn in mortgage payments. Let's look at a different point. When did payments peak? 1990. So 1990 was right about when mortgage payments flatlined to starting to go down. So again, another peak, 1979, that was just before the top in mortgage payments. Almost any time on this way up for this uptrend, it would have been a fine time to buy a house, or an okay time to buy a house. But if you buy right before the top, then it ends up being like the peak in your break-even time, at least in those two cases. So let's look at this other relative peak. So 2005, you buy in 2005, again, that's just before the market topped. And that about is the most data we have. We could say 2014, that kind of was right before this local top, and prices kind of flatlined, went down a little bit. I wouldn't say that's super reliable. So when was the lowest break-even time? 2009. So 2009 was obviously this trough in the housing bust. So I could not hold myself back. I had to go ahead and add in these sort of bands well, the linear trend line from 1980 to 2020, as well as standard deviation bands. So one standard deviation above that trend line, one standard deviation below that trend line, to see, okay, there is a chance that we never come back to this sort of main trend line. Any sort of technical analysis based on trends may or may not work. But if we do come back, probably the place to buy would be around a retest of this trend line. And given that we are rolling over up here, I think that would be, a decent place to look. If not, we could have something like this in the 1970s where basically it bottomed after not very much of a pullback in the mortgage payments. So this is kind of, I guess, what I'm looking for is more of a pullback. I think we'll see as the economic situation unfolds where prices are going to be headed. I think prices are going to come down. I think they're going to come down not nearly as much as people want or hope. And that's just because 2010 to 2020 really were was like the best possible prices you could get for housing. And we're probably not going to see those again in the next 20 years. In fact, I would probably bet that we would not see those kinds of price ratios, mortgage prices to income ratios. So the hope is that prices do come down a little bit. I think the risks might make it hard to buy a house. Like if we do have a financial crisis that really brings prices down to where people would want them to be, people probably won't be able to buy houses. The people in good financial positions who don't have all cash ready to buy will not be able to get mortgages. At least that's how it was in the 2008 crisis. I'm not sure when people were not able to get loans, like pretty much at all, but I know when the crisis was at its worst, I think even as far as 2012, you just were not able to get loans. So the housing market will likely bottom and rebound before you're even able to get a home price or a home loan. So that is something to take into consideration. You may be waiting a long time if things get really bad to buy a house. And maybe that's the best way to go, because you can see it takes a long time for home prices to break even if you don't buy at a favorable time. So no matter what, buying a house is a long game. At least a 10-year time horizon seems to be the minimum if you're to consider buying a house, at least to be safe, that it's an okay investment. Otherwise, there's probably not much issue in just continuing to rent. The risk on the renting side is, well, if inflation continues to skyrocket, then affordability may just get even worse. What would drive inflation to skyrocket? I think it's at this point going to take a crisis for that to happen, and sort of the money printers to turn back on, extreme fiscal borrowing, things that are going into industry, things that drive up the prices of labor and base materials, your copper, your energy materials, all those things, your lumber, would drive up prices more. And that would just be general inflation, right? So like everything would be going up in that environment pretty extremely. And I think the stage is kind of set for that to potentially happen. We just haven't been investing in base resources or energy like we need to. And so we're going to run into supply shortages if we don't get a extreme and prolonged drop in demand very soon. A short drop in demand would drop those prices for a short amount of time. That would be like kind of your buying opportunity for anything and everything. And then after that, it's kind of off to the races. I don't see inflation being low long term. I do think we're going into a sort of super inflation cycle. Maybe it won't look like the 1970s. Things are going to get pretty rough for the consumer. No chance wages keep up with inflation, except for at the very top jobs, which if you have the highest paying job, you probably are not worried about buying a house. So that's, I think, my take on it. Again, most people say don't try to time the market. I think timing the market, at this point, things could get worse than they are now, but I don't think they'll get worse until they get better for home buyers. So at least everything seems to be pointed in the direction of prices coming down. Now, I think most of what happens in the midterm, like 5 to 10 years out, is going to be based on like demographics of the region. How desirable is the area you're looking at buying in? Are people moving out? Are people moving in? Again, like I think in my region, population hasn't been growing very fast, but there's, the very desirable areas like Florida, population has been increasing very fast. And within those states, there's regions, cities that are more popular than others. Where can people get the jobs? Where are jobs going in the future? Those are all things to consider. And that's stuff I haven't gotten into at all in this presentation. So I think that's everything I had to cover.